Hello, friends. Every April, many Americans over 65 still send the IRS tax money from retirement income. A new law changed that tax math for retirees who are neither wealthy nor low income. It targets the middle group, the people retirement rules were supposed to protect most. The new senior deduction is $6,000 for one eligible person on a return. For a married couple where both spouses qualify, the deduction can reach $12,000. It applies for 4 tax years from 2025 through 2028. After 2028, the deduction is scheduled to expire unless Congress extends it. When this deduction stacks with 2 older deductions, the tax result can change sharply. Most videos mention the law, but they never show the full stacking calculation clearly. This video breaks down who qualifies, who does not, and how the deduction actually works. It is meant for U.S. adults age 65 and older reviewing their retirement tax situation. The information comes from public sources such as the IRS, Congress, and AARP reporting. This is educational content only, not personalized tax, legal, or financial advice. Your tax situation may be very different, so confirm details with a qualified tax professional. Stay to the end because the stacking math is the part most people explain badly. Before anything else, let us be honest about who this deduction really will not help. It does not help you if you do not file a federal income tax return in the first place. If your income is below the filing threshold, there may be no federal tax to reduce. The deduction also does not help people whose income is above the phase-out range. For single filers, the deduction starts shrinking above $75,000 of MAGI. For single filers, it disappears completely at $175,000. For married couples, the phase-out begins at $150,000 of MAGI. For married couples, it disappears completely at $250,000. This deduction does not create a refund check by itself or send separate money from the IRS. It lowers taxable income, which may reduce tax owed or increase an existing refund. The deduction is real and confirmed, but it works inside a tax return, not by mail. If you already filed your 2025 return, check whether you missed the new deduction. Tax year 2025 was the first year this senior deduction existed at all. The new rule required a new tax return form called Schedule 1A to claim it. Some early filers sent returns before tax software had fully updated for the new form. Many January and February returns may have been filed without Schedule 1A included. To check your return, open the copy you filed and look specifically for Schedule 1A. If Schedule 1A is missing, compare your total deduction line with the correct stack. A single senior under $75,000 should show about $24,150. If your deduction is much lower than that, the new senior deduction may be missing. The form used to fix this problem is Form 1040X, the IRS amended return form. You do not refile the whole return. You update only the lines that need correction. Attach Schedule 1A, apply the senior deduction, and submit the amended return. The IRS says amended returns generally take around 16 weeks to process fully. The deadline to amend a 2025 return for a refund is April 15, 2029. There is time to fix it, but filing sooner usually means the issue resolves sooner. For 2026 and later claiming, the deduction should be more straightforward. Most tax software will ask your age and apply Schedule 1A when you qualify for it. If you use a preparer directly, ask them to confirm Schedule 1A before you sign. The full deduction is $6,000 for a qualifying single filer age 65 or older. For a married couple, the full amount is $12,000 if both spouses qualify. If only one spouse is 65 or older, only that spouse's deduction portion applies. Here is why checking your 2025 return can be worth 10 careful minutes. Imagine Dorothy, a 69-year-old retired nurse in Ohio who filed in early February. She used the same tax software she trusted for years and received a small refund. 3 months later, a neighbor mentioned the new senior deduction for older taxpayers. Dorothy opened her filed return and saw that Schedule 1A was not included at all. Her total deductions were clearly lower than they should have been for her situation. She filed Form 1040X, corrected the relevant lines, and attached Schedule 1A. The amended return produced an additional refund because the deduction had been missed. The original filing was not careless. The software simply had not caught up yet. For retirees with a traditional IRA, this 4-year window deserves a tax conversation. Every dollar withdrawn from a traditional IRA is taxable in the year you take it. Normally, retirees limit withdrawals to keep taxable income as low as they reasonably can. That strategy still makes sense in many years, but this window changes the question. From 2025 through 2028, the new deduction can offset taxable income. That may make some IRA withdrawals cheaper for tax purposes than they will be later. In 2029, the deduction is scheduled to disappear, so the tax cost may rise. If required, minimum distributions are near. This window may be especially important. The same tax planning idea can also apply to Roth conversions from a traditional IRA. You pay conversion tax now, while the senior deduction may help absorb part of it. Future qualified Roth withdrawals can then come out tax-free under current rules. This is not automatic advice. It depends entirely on your income and tax picture. The key question for your advisor is whether this deduction changes your IRA strategy. Now let us look at the actual stacking calculation for seniors in 2026. The first layer is the regular standard deduction available to most taxpayers each year. For 2026, the regular standard deduction is listed as $16,100 for singles. For married couples filing jointly, the regular standard deduction is $32,200. The second layer is the older additional standard deduction for people 65 or older. The third layer is the new senior deduction created by the recent federal law for seniors. For one senior, the three layers can shelter about $24,150. For a married couple where both spouses qualify, the stack can reach about $47,500. That number matters because it shows how much income can be sheltered before federal tax appears. Now apply that deduction stack to Social Security, which is not always fully taxable. The IRS taxes Social Security based on your total income, not just the benefit itself. For many middle-income retirees, the stacked deductions can absorb the taxable portion. When that happens, the federal tax bill on Social Security can fall all the way to zero. Not lower by a little, not slightly reduced, but zero federal income tax on that benefit. For couples near the average benefit range, the stacked threshold can be even more powerful. Combined benefits may sit well below the married senior deduction stack for many couples. That is the real effect of this law. For the retirees, it was designed to help most. It is not a bonus payment, not a stimulus check, and not money mailed separately. It is a tax shelter inside the return that can protect Social Security and modest income. Here is the full picture in simple terms for anyone watching and trying to decide what to do. If you have not filed your 2025 return, confirm Schedule 1A before submitting. If you filed early and Schedule 1A is missing, Form 1040X is the form to use. The amendment deadline for a 2025 refund is April 15th, 2029. If you have an untouched traditional IRA, discuss withdrawals or Roth conversions before 2028. The center of the whole issue is the stacking math, not a mysterious government payment. Three deductions together may shelter about $24,150 for one senior. For qualifying married seniors, the sheltered amount may reach about $47,500. That can be enough to bring federal tax on average Social Security benefits down to zero. Before closing this video, pull up your 2025 return and check for Schedule 1A. If it is missing and you qualify, ask a tax professional about Form 1040X. A CPA-enrolled agent or verified tax service can confirm whether amending makes sense. Also ask whether the deduction changes your IRA withdrawal or Roth conversion plan. If someone over 65 filed early without help, share this information with them. The window stays open for years, but the sooner it is corrected, the sooner it resolves. The next video explains how Social Security taxation works and when benefits become taxable.